Hey, welcome back to the Consulting Mind. Today, we are going to talk about a very fundamental and yet critical concept, which is the Fed fund rate. Very often, we heard a lot from the market or from the media to talk about the interest rate, the Fed fund rate go up or go down. But what exactly is Fed fund rate and how it's being determined by the Fed from time to time? Today, we're going to walk through you these concepts. So, let's start with what exactly is Fed fund rate and why it matters so much to us, to every investor in the market. So basically, this is the target interest rate that is set by the Federal Open Market Committee, which is also known as the FOMC. And it is also the rate at which commercial banks will borrow and lend each other their excess reserve overnight. So why it matters so much? And because basically it influences all the short-term rates, including but not limited to the consumer loans and credit cards. And it also have a very huge impact on both stock market and bond market. And basically, the FOMC set the target federal fund rate 8 times a year in the FOMC meeting based on the set of prevailing economic conditions or based on their understanding of those conditions. So before we move on to talk about the Fed fund rates, we should first have the very critical understanding on the terms, which is known as the IOER, the interest on excess reserve. So what are bank reserve? This is the cash minimums that all financial institutions should have on hand in order to meet the central bank requirements. This is for the sake of ensuring that every bank can meet any large and unexpected demand for withdrawal from time to time. So then, what does interest on excess reserve mean? This is the Fed will pay interest on excess reserve to bank because bank will have very little incentive to keep excess reserve because cash can earn no return or very few return. And they will also lose value from time to time due to inflation if they put a lot of cash into this excess reserve account. So therefore, bank will have very little incentive to keep excess reserve, but they will have a very strong incentive to lend out the money as much as they could to maximize the ROI. So then, how exactly is that IOER works? Let's say for now, the IOER is at the level of 25 basis point, which means that the bank can gain 25 basis points for sure if they place money at the Fed with no risk at all. And for banks who need money, they will have to offer higher than 25 basis points in order to obtain the fundings required, because essentially they will have to compete with the Fed on the funding. Because think about that, if you are the bank, if you have a chance to lend to the Fed at 25 basis point at almost no risk, why would you have to lend to the other banks at the level lower than 25 basis point with some risk incurred? So naturally, there will be arbitrage happen below when the funding cost below 25 basis point. So theoretically, the IOER is effectively the bottom line of interest rate in the market. So what are the problems we saw? As you can see from the graph in the blue line, which is the IOER, set at the level of 25 basis point. As you can see from time to time, the blue line is well above the red line, which is the Fed fund rate. So why does that happen? As you can recall, the IOER was only for bank. So in other words, for other non-bank financial institutions like the money market fund, the pension fund, the Freddie Mac are not being covered into these financial tools. So effectively, the intended purpose for the IOER to being the bottom line of the interest rate corridor did not happen, and instead it became the top line of the interest rate corridor. So how did the Fed fix this problem? They come up with a new monetary tool which is known as the overnight reverse repurchase agreement, also known as the overnight repo. So this overnight repo basically target the non-bank financial institution which is not being covered in the IOER. And now the financial institution can then lend money to gain the overnight repo interest to the Fed. And then the FI will then demand interest, an interest rate which is higher than the overnight repo for them to justify the risk and return, because otherwise they can simply directly lend the money at the rate of overnight repo at almost no risk. So therefore, the overnight repo effectively become the bottom line of the market interest rate, and this impact will also being channeled out to other market. So what about the effective Fed fund rate? With the invention of the IOER and the overnight repo, effectively these two rates has become the upper and the lower bound of the interest rate corridor. As you can see in the graph, the Fed fund rate in blue is effectively moving around in between the red line and the green line, which is also the IOER and the overnight repo. So understanding the interest rate corridor is a very important and yet critical lesson for us to understand how the Fed is influencing the market interest rate. Although there are now different new invented monetary pool or interest rate tool for the Fed to influence the rate, this is also important for us to understand the basic logic behind. So what about the terminal Fed fund rate? Basically, this is the final interest rate that the Federal Reserve set as its long-term target for the Fed fund rate. To do so, it will involve forecast future economic conditions, including but not limited to the inflation, the GDP growth, and the unemployment. And the Fed may actually incrementally raise or lower the rate over time to achieve the terminal rate. The terminal rate itself may be adjusted up or down as the economic environment shift. And on the opposite, the Fed fund rate itself is the current short-term target interest rate, which is set by the FOMC. So this is it for today, and I hope it helped you to better understanding this very crucial Fed fund rate. If you think this episode helped you to understand a bit more about that, please click the like button and subscribe for me. See you soon.